You're listening to the Spicy Dividend.
What's up, everyone? It is the Spicy Dividend Podcast. I'm Scott. I'm your host. You can follow me at Twitter at DGenDividends, D-E-G-E-N Dividends. It is March 29th, 5:22 p.m. Eastern in lovely Pennsylvania. So, Sunday, obviously markets are closed or whatever, and by the time I'm recording this, the futures aren't even open yet, so nothing stock-related to talk about right now. Today's going to be a little bit more personal, but it's still stock market and related. And, do I regret the huge mistake that I made with the options trade at Berkshire Hathaway and then essentially taking out $30K in my portfolio? So to backtrack, if you haven't heard the story before, basically at the peak, my individual portfolio was up to $51,000, okay? I made it to about $49,500 with pure dividend stocks. And then I eventually cashed out and day trade it and swing trade it to about 51,000 and change. The highest amount I had is on Instagram. It was just slightly above 51,000. And essentially I did a $13,000 call option on Berkshire Hathaway right before earnings. I anticipated really good earnings, and they did have decent earnings, but, who knows how the market would have played out had we not had the coronavirus impact on it. I'm telling you, I literally could not have picked a worse time to do a call option because it doesn't matter how the earnings would have came out. The entire market that day, the next day, went down like 4 to 6%. So it really wouldn't matter if they blew earnings out of the water, they still would have went down the next day or even that day. So look, earnings came back mediocre. Of the $13,000 I spent, I end up losing $10,000. I freak out. I end up cashing out $30K of the portfolio, putting it into my wife and I's emergency fund. And then I lost $4 to $5K doing random miscellaneous other trades that were pure gambles. Eventually, I'm essentially starting over on my portfolio. So right now, in the individual portfolio, I'm at like 5,200. Was a little bit higher. I was experimenting with some other stuff. I eventually cashed some of that out. I think the portfolio was to like 8,000. It went all the way down to 3,000 because I took 4,000 out of it out, and then 1,000 I tried in speculative stuff. Didn't work out. So we were down to about 3,000 for the individual portfolio. Right now I'm starting to build it back up. And I made a very nice swing trade on Penn and also Ford that I ended up making about like $900 from that. Right now, the portfolio as it sits is at $5,300. If you count the premium income that I received for selling 100 shares of SLV, the Silver Trust, I'm up to about $5,500 in total assets. But 51,000 to 5,000. Now I know 30,000 is locked away, so theoretically I didn't lose that amount. But 51,000 to 5,300, where we're at right now, do I have a lot of regrets? Now look, yes, I mean, obviously you're going to have regrets when you lose that much money, especially for me, because it was basically 2 years busting my ass off trying to earn side hustle income, and literally every single dime I made from side hustle income went into that portfolio. So to lose it all very quickly in a matter of a day or two, and then, essentially stash away 30 so I can't touch it, it's safety measures against myself. And then to go on from, of course I'm going to have regrets, okay? You never want to lose money, especially when it was all from me busting my ass on side hustle incomes, writing books, doing YouTube videos, doing podcasts. What else was I doing to make some money? Oh, Mechanical Turk. That was like $1,000 a year. I started doing reading ebooks. So what kind of audiobooks? I was narrating audiobooks. There you go. That's the proper terminology there. I was doing everything possible I could to make a few extra bucks and then take that money and just put it in the portfolio. Stupid me went really aggressive and lost it. So yeah. If I would have went to an all-dividend portfolio like I had for so long, for 2 years now, and never touched it, never changed the philosophy, yeah, I'd be down just because everything's down right now. But I'd probably still have, let's theoretically just say I lost 20% of the portfolio. I'd have $40,000 still in the $40,000 in the portfolio as opposed to the $5,000 I have now. Now look, I'd be lying to you if I said I wasn't a little bit depressed for like a week or two just about it. I mean, look, when your whole side hustle income is based on like finances and in the market, and then you lose a large chunk of it from the market, it hits you hard. Okay, it hits you hard. It's economies of scale. 50K to a lot of people is nothing. 50K to someone like me is like, that's really stupid. Really stupid to go and do something that aggressive. It's a lesson learned, yeah, blah, blah, blah. I know that. But it opened my eyes to other things, to swing trading, to day trading, to options trading, to day trading, options trading, to where I am now, which I'm really upset that I never really took the time to focus and learn covered calls. I'm really excited about covered calls because they truly are right up my alley. If you're someone like me who, they're dividend oriented, but they're not so dividend oriented and so blinded to dividends. They have the blinders on, running down the track, looking at dividend only, cash flow only. Look, I'm open to total return because that's ultimately what you're going after, right? Total return. If you bought, a lot of shares of SPY, the S&P 500 ETF, and then let that ride, and you ended up making double your money when you invested like 5 or 6 years ago or whatever, you're not going to complain because you don't have, proper cash flow from dividends or anything. No, the whole point is total return. And a lot of dividend investors get upset when people talk about dividends are irrelevant. That's not what they mean. Dividends are just a factor of total return. Like, we all want to make money, and you want to make the most money possible. You're not going to take less money just because it pays a dividend. That's stupid. And that's what a lot of people, they don't see the bigger picture when they're so blinded by dividends and cash flow coming in, that it's like the whole point is to make money. I'd rather turn 5,000 into 10,000 rather than 5,000 into 8,000 and have them producing dividends. Like, it doesn't make sense. I'd rather have more money, period. So covered calls is really interesting because you can buy already paying dividend stocks and then get even more income. So it's like, I like the income coming in aspect of money because at that point it becomes like an asset to me. So when you buy something like a Penn National Gaming, which I was going to do, which does not pay a dividend, I can buy 100 shares, sell covered calls, and essentially it's like I'm creating my own dividend from that. So I'm very upset with myself that I never learned this mentality or learned this, the process of covered calls earlier. I was blinded by dividends and dividends only. And then I saw, I stupidly admit that I follow Wall Street Bets because it's hilarious. And there's a lot of degenerates out there just like I am. And I see it myself and a lot of these young kids. And they just go for broke and go for the home run. So that's another aspect of where it's like, yeah, that was really stupid of me. But at the same time, do I regret it? Yes and no. The no part is because, look, I just turned 29 years old last Sunday. And it's like, I did go for the home run. I really did. Because if things would have played out the way they, I anticipated it, I probably would have been 20 to 30K richer. And, I just went for it. At the end of the day, I just went for it. And it could have been the ultimate home run because I was pretty much cash only in that options play at that moment in time. So if the options play would have worked and then I cash out and then let's say the market tanked like a week later, well, I would have been heavy in cash. It would have been literally the perfect storm where I would have cashed in from that nice options play and then I would have been 100% cash or been doing some swing trades or whatever. It really would have been a perfect scenario. Then I could have hoarded up all that cash and then spent it when I felt a certain holding of mine was a lot cheaper. And like I said, it just would have been a perfect storm. So do I regret it? Yeah, of course I'm going to regret losing money. But there was a part of it where I was just like, you know what? I'm young. I can make it up. I really can make it up. Maybe retiring earlier, like in the 40s, isn't going to happen now. That's fine. It is what it is. I'm young. I went for the home run. Swing and a miss. Strike three. McGuire goes down looking. Swinging, I should say. If I said swing at strike three, dumbass. Anyway, so look, there's always going to be a little bit of regret in there. But at the end of the day, I was young and I took a risk. So now I'm still investing in dividend-paying stocks. And I'm a little bit more aggressive on the types of positions that I'm trying to build up to 100 shares. Now, look, I don't have that much discretionary income right now. So my choices of buying 100 shares of something are a little bit limited. Obviously, you can only, if your budget is $2,000, let's say, and you're only going to be able to afford stocks that are $20 and under. to get 100 shares of. So your pickings are a little bit slim. So I believe my 100 shares of Delta is a really aggressive play for what I'm trying to do. But at the same time, there's a lot of volatility. I can get a lot from those calls, selling those calls. And if it goes up and I end up having to sell the 100 shares, well, you know what? The amount in the portfolio is just going to go up. So it's just a different perspective on how to get income from your holdings in the market. Now, something that I would be interested in, because they just actually, I don't know if they raised it or if it was at 52 cents, but AT&T just declared a 52-cent dividend. I don't know if it was 51 or if it was 52 the last time they paid it, but I don't own it right now, so I'm not following it too heavy. But that'd be one that's very interesting because they pay a really high quarterly dividend right now. It's floating in like the $28 range last time I checked. It could go down quite further. Now, look, they're a company that has a lot of debt, and in this environment, you really don't want to have too much debt on your hands, but that'd be something where you could get the high yield from the dividend itself, and you could also sell covered calls. So it's like you can get weekly income or additional monthly income from the holdings of AT&T if you have 100 shares, and then you could also get the dividend itself. So, and again, something from AT&T is going to be a qualified dividend, so that's even better. The covered call income is going to be treated as ordinary income. But it's just one thing to look at. You could do it with dividend stocks. And look, if you like the idea of covered calls, but you don't like the idea of losing your shares, well, then you can do really out of the money sells. So that way it's like maybe you only get like $2 or something, but there's like, you need a miracle for it to hit. So it's like you need the equity to go up like, I don't know, like 30% in 3 days, which again, it's possible if they have earnings or if like this extreme volatile market happens, but it goes up like 30% in 3 days in order for you to get your 100 shares exercised or something. Yeah, that's a possibility, but it's 99% of the time not going to happen. You can just collect a little bit of money here and there from your assets and hold on to your shares. Now, look, even if they were to get exercised and they grow like 30% in 3 days, is that really such a bad thing? I mean, you're taking the cash from a 30% profit immediately. The only time that might be bad is if like you're already in the hole a ton of money. Like let's say you went all in on AT&T when it was like $38. Now it's at 28 and you're selling like $31 strike prices. Yeah, if it goes up that fast to 31, it's like, yeah, you made a nice 30% increase from the time that you sold covered calls, but you're down on the position big time. That might be a scenario where you just start accumulating more shares and you don't start selling covered calls until you're closer to your cost basis. But look, everyone has their own mentality, so just a little reflection on what happened in my portfolio. Yeah, if I would have just stuck to straight up dividends, I probably would have been in a whole different situation right now. And, if I ended up taking the path and still somehow coming across covered calls when I was hell-bent on dividends, yeah, it would have been a different situation. I would have had $40K to probably play with, and then buying a whole bunch of different 100 shares of different items. And, if I spent around the $20 in equity, so $2,000, I could have bought 20 different holdings, had 100 shares of each, and then just doing rapid revolving, weekly calls and then getting a lot of income that way. Yeah, it would have been very interesting. But, this is the scenario that we're at right now. There's nothing really I can do about it to change it except work my ass off again and build it back up. Hope you enjoyed today's podcast. It is, and no, I'm not coughing because I have like corona. My voice is extremely dry. I need a drink because I just had a tomato pie. But anyway, hope you enjoyed Sunday's podcast here. Episode, what are we at here? Let me click. What is it? 35, 36? Can we click episodes? Today is going to be episode 35. Wow, these episodes are just flying by now that I'm doing them almost daily. So hope you enjoyed it. Let me know your thoughts if you're listening on YouTube. Let me know your thoughts on if you're following me on Twitter at DGenDividends. I will see everyone tomorrow for Monday's podcast.